Econo Chat. We did it in Bloomberg Business Week. Here's the cover. Let me bring up the issue from a number of weeks ago. It was a great success. We thank you for your many comments on it. There it is, a crisis that won't go away. It has been a year of tumult in the Middle East. And we go to Alia Moubayed of Barclays Capital. Good noon to you from Barclays Capital.
Hi.
You look at the Middle East, and it is about oil. Mm-hmm. What price of oil is fiscally responsible to the governments of the Middle East? As a general statement, where do they need to have Brent or NYMEX so that they break even or make money on their fiscal policy?
I mean, obviously, every country has a different break-even point. Let's focus mainly on the main largest producer, which is Saudi Arabia, and who will remain, even in these tumultuous markets, the big player both on the production and on the what it wants of the oil price. We estimate that Saudi Arabia's fiscal break-even point has increased from around $78 a barrel in 2010 to around $91 a barrel in 2011, and we expect, and that obviously is related to the huge fiscal stimulus package that Saudi Arabia has put in place over the last year and is likely to continue, though fading away slowly in 2012. So our view is that over 2012, while Saudi Arabia could and some other GCC countries could accommodate a lower oil price, however, they will remain very careful as not to bring it below a minimum level that fits with their fiscal fiscal break-even points and also their fiscal plans for the year, given the challenges that they are likely to face.
And that is a breaks loose. I'm sorry, I've never heard that, folks. Saudi Arabia with a $91 handle to fiscally break even. Let's look at some of the equity tumult and bring it back to the economics. This is a Kuwait Stock Exchange, and I say this off of the Arab Spring, and it's just the Arab lethargy. Alia, we see the knock-on effects of the financial crisis and the political events. For 2012, can we see recovery in the economies of the Middle East?
I'm afraid that what we will see is a continuation of its two-speed region, a region of oil exporter, a sub-region of oil exporter, which will be able to grow at relatively moderate to high levels, 4 to 5%, depending on where production of oil will stabilize next year, given the supply side and the return of Libya. And then you have a much weaker growth sub-region, which is more sort of the Egypts, the Tunisias, and the Moroccos of this world, but particularly Egypt in particular, given the continued both domestic turmoil that the political transition is imposing on them, and on top of it now they are facing a much more challenging external environment, given their very strong linkages and openness to their European markets. So overall, I think what for the MENA region growth as a whole, we will stay around a weighted average growth for the region of around 4.1 to 4.2%, because there is a rebalancing between the two regions.
Okay, that's a very nice summary, Alia. Can the region demographically and with the incredible youth population and the discontinuity of some with oil, some without oil, can they be economically stable given sub 5% GDP, or do they just need more by definition?
Obviously not. I mean, the likes of Egypt and Saudi Arabia, where demographics are biting, I think growth above 4 to 5 for Saudi Arabia, and definitely more than 6 to 7% for Egypt, are necessary in order to absorb the new entrants on an annual basis to market. While Saudi Arabia can afford basically to mitigate the impact of a lower growth for a while, unfortunately Egypt is not, and this is why we think that Egypt's outlook will be one of the most challenging economically, socially, and politically next year.
Alia, how linked is the Middle East to the Indian economy? If we get a difficult economy in India, how does that impinge upon the Middle East?
I mean, certainly the strongest links to India are rather in the Gulf states because, and particularly the UAE, to a lesser extent Saudi Arabia. This is India, like China, is one of the most important consumer of oil exports from Gulf countries. So to that extent, some of their exports could be affected. But again, I don't think it's going to be a huge hit, particularly if you think that tightening sanctions on Iran, which is also a major supplier of oil to India, are likely to become more and more difficult given the sanctions that are likely to be tightened now, and that Saudi and UAE could step up to fill that gap should it happen.
Right. Alia, thank you so much. Alia Moubayed coming to us from Barclays Capital.